I will allow, and this is something we find at our investor days, and I certainly very humble about this. Actually, hearing it from the companies themselves is much more valuable. So, with that, I'll hand over to Mike to give you a sense of Form 3.
When my imposter syndrome kicks in, I haven't got quite so many charts as I've seen. But look, thank you very much for having me and an opportunity to talk a little bit about our business and what we're shooting for, and I guess where Molten have helped us with that journey. So I guess if I'm going to do a couple of sort of geeky technology bits, but I think it's really important that we start actually with some fundamentals. And we all know this is true in our day-to-day lives, but I don't think this has been fully internalized inside the banking infrastructure of the world. And that is that the expectation for any form of digitization is that it is always on, and that it is always real time, and that it's fast and consistent and safe. And the world of payments needs to deliver that as cheaply, fastly, and robustly as possible in a geopolitical environment where people are shooting at it. And so the world of real-time payments across markets is here to stay. So there are something like 70 different pieces of central infrastructure in countries around the world deliberately designed to allow for financial institutions to transmit money on behalf of their customers in real time. That is increasing rapidly both in the number and the scale of those operations. So there are more account-to-account transactions in the world than there are card transactions in the world, by a factor of about 5. This is where utility bills are, it's where mortgage payments are, it's where loan repayments are, it's where bill splitting at the end of the day is, it's where sending money to your kids is, it's where the money from your grandparents arrive, it's where insurance companies pay out disbursements under claims. The ecosystem around account-to-account is super well established, but it's knackered. And it's knackered because most of the infrastructure in banks is really old. It's not a little bit old, it's really old. There are systems running in tier 1 banks that were written in the 70s, and they're still using them at industrial scale for account-to-account transfers. And so when the digital economy, whether that is AI-driven or not AI-driven, crashes into the bank landscape, it doesn't really matter how good the challenger banks are. Their volume is a rounding error in this environment. In most markets, 80 to 90% of the volume that's operating in account-to-account is a handful of tier 1 banks, typically universal in scale, with many tens of millions of customers each. That's where all the volume is. And these are exactly the organizations that were there when it started for the first iteration of account-to-account and now the journey into real time. And they got some problems. And they're spending their way out of it, or they're trying to spend their way out of it. And I think Luke earlier was talking a little bit about this in terms of the cost-income challenge that exists inside banks. Something like 80% of the technology investment spend in banks is just to keep the thing working. And it is as blunt as that. So even 2, 3, 4, 500 million pound technology budgets in the payment ecosystem of tier 1 bank is just to make sure it doesn't die. It's not to make it better or do a Bitcoin shiny or work out what they're going to do in the Internet of Things. It's to make sure that your salary arrives, and it's to make sure when you initiate a payment that you're not sat watching a spinning wheel of death on your iPhone wondering why it doesn't work quite so well as a tap and go. Yeah? But the amount is staggering. So these are annual spending numbers from the top tier banks. So in the world of just connect me to that landscape of payment ecosystem and manage a payment flow, something like $15 billion a year is going in from banks. Every year, year after year, at 80% to keep it working. Something like $60 billion a year is being spent by these organizations broadly on who the hell are my customers? It's a bit staggering, right? But nonetheless, who are they? How do I make sure I keep myself safe? How do I avoid fines? How do I really, really know that I'm protecting the ecosystem that I'm responsible and deeply regulated for? Yeah. About $100 billion goes on a calculator that says when you sent that money yesterday, your balance went from X to Y. $100 billion a year on calculators. Yeah. Now, what's interesting about this ecosystem is this is also where you have to make sure it's done correctly. You have to make sure you can reconcile this stuff. Actually, some of these transactions are super complicated, so they're not just a subscription that comes out every month. It's a variable subscription that's moving against loan calculations, and is that loan calculated daily or hourly or monthly, or so they're calculators, but they're quite complicated, right? Large numbers of banks don't know what will happen if they turn off their current calculator, because what they've done over the course of the last 40 or 50 years is protect the calculator by wrapping it in cool, shiny things at a rate of $60 billion and $15 billion a year. Yeah? And if you wrap all of that together, the revenue streams that sit around these are something in the order of $1.5 trillion a year. This is what the ecosystem of payments is creating in revenue from their customers, which they're then funneling back in at an extraordinary high level to keeping the lights on in these pillars of technology. It is somewhere in the realm of batshit crazy. Yeah? Their bespoke technology is in big trouble. Every bank has solved that problem differently. A tier 1 bank is effectively a market of one. Their customer base is different, their geographic footprint is different, how they emanate their way to their size is different, the markets they operate in is different, who made the decisions on their technology, when they went in, when they didn't, when they started a product, when they didn't start a product, whether they are a card shop or not a card shop. Every tier 1 bank on the planet is effectively a market of one. And so what they've reacted to that market of oneness with is, I'm special, I'm going to build some stuff myself. Yeah? Because only I know. We disagree. Why is it broken? It's broken because the world of monolithic architecture and monolithic software development is really, really not where you want to be in a fast-paced change environment where new competitors are trying to kill you from the cloud. So I have worked in large banks before, and it would cost something in the order of $2 million to just create a test environment to work out whether the thing I wanted to do was going to work or not work. That's not the same as rolling out into production 15 times a day. It's just, you could not describe a technology landscape further apart than the legacy payment infrastructure of tier 1 banks and the real world of now streaming, cloud native and consistent and continuous development. But the regulators are after them, and they're after them because this stuff cannot break. So it needs to always be on, and they're checking. They're also testing. So one of the other things Luke was talking about before in his view of cost income is, to what extent should you have operational capital in a bank? So should you be holding money on the off chance that your technology breaks? In what industry do regulators create environments where they're so concerned about your technology stack that they are contemplating making you hold money on the off chance that you didn't get management of it correct for your customers? Cost income ratios are in trouble as a result of this. They're broadly flat. Thankfully, Luke did a chart. I don't have to. That's great. And there's loads of new shiny stuff, and they can't get at it. Like, you can't get at it. As a tier 1 bank, your ability to opt that and then distribute it consistently en masse to 30, 50, 80, 100 million customers in multiple countries, game over. Yeah? We covered this, but the new entrants are being super sneaky. And the things they're gunning for are the high margin customers that these banks really don't want to lose. They're not after scale. The scale is stuck in tier 1 banks. The people, the organisations that are coming up on the sides are nibbling around the edges and taking all the high value, high margin products from these large banks whilst they try and work out what to do. So we're going to have a go at fixing some of this stuff for as many of them as we can by building and running a payment platform that these banks connect to, so that the infrastructure and the management of those payment flows is done by an organisation that just does nothing but that. And we just do it really well. And we do it big. There isn't really anybody else having a go at this, because it's also a little bit crazy. And there are a lot of organisations in the legacy environment who have consistently been the recipient of that spending profile. So we've had to engineer ourselves and create a franchise which just operates completely differently to a Fiserv, an FIS, a Finastra, an ACI. Yeah, and that's typically the software that is running inside these large organisations. So I thought, I've gone a bit techie, it's gone a bit wobbly. Let's think about a digital challenger bank for a second. Apologies, it is sort of loosely technology topography, but let's go for it anyway. So banks surface channels to customers. So think mobile app, think web front end, think file transfer for big corporates, yeah, channels at the top. Most banks have loads, not one. Bad problem, right? A new digital challenger bank has got one, and it's a really good one, and this is the differentiated user experience that we all know and love, which is why we've probably got a primary bank account with a really big bank because we think they're safe, and a second one we use all the time because the digital experience is just really cool. There's a few nods and grins, but this is the norm, right? So a digital challenger bank has one of those. They have a new shiny calculator, core. They have a couple of systems that will manage the catching of, I want to make and receive the movement of money. They'll process it because they're going to do some checks like, has the bank even got enough money to make this payment? Are we on? Does it work? Have we got enough of that currency? All that good stuff. They'll wire it into the central infrastructures of countries, but even digital challenger banks typically will have a stack per payment type. And that's completely normal because each payment type behaves a bit differently. Ta-da! We do that. Okay? That is an actual technology diagram from an actual tier 1 bank for one payment type in one market. Yeah? This is all the stuff that nobody ever sees. And this is where we play. Okay? You can see why occasionally they send you a message that says, we're going to turn it off for a few hours. We're really sorry for the inconvenience. We're going to do some stuff and it might come back. Yeah? This is why. Yeah? So, same diagram. Same diagram from a bank that operates in more than one country and probably has a few different types of customers. So not just some consumers, right? These guys have got genuinely a web app. They've got a couple of them probably. They've got some consumer apps. They might even have more than one consumer app because there's probably a wealth one because you're special. And then there's a non-wealth one because you're not special. And then there's some branches, and then there's some files, and then there's all this other stuff. And then if they're really cool, some bank somewhere will tell you that they've got an API. Good luck. And then what they will do is they will take that and they'll bung that into a bunch of different calculators because there's probably a calculator for the mortgage book, a calculator for the credit card book, a calculator for the loan book, a calculator for the currency book, a calculator for the domestic large-scale retail book, loads of calculators. Loads of can we catch and make money move. Do some processing, plug it in. This diagram is for if you were going to try and do a ish universal bank in just the UK, Europe and the US. Just 3. Okay? So, here. Okay, we get the gist, right? If you're one customer, this is cool. Always on, because we run 24/7, cloud native, built from the scratch. Always big enough. So one of those previous little boxes on that horrible, god-awful diagram, if that runs out of memory, payments stop. If the box goes, payments stop. I have seen banks on eBay buying bits. Always current from an industry perspective. This is really important. So the regulators are going for these guys, right? Can we do more formats? Can we transit more information? Can we do that in a slightly different way? Staying current across that previous landscape is really hard. You've got to cut these guys some slack. So the people who are in banks today are not the people that created those god-awful pictures 30 years ago. They've inherited some of this stuff. So this is also why you see some slightly stressed CTOs in banks, right? Because they've got to try and unpick it all whilst it's running. This is like trying to change the wheels on a Formula One car on the track at the same time as no customer feels it, whilst a regulator is telling you, do not fail. Under any circumstances, zero tolerance. Yeah. You've got to design in security because the bad guys are coming hard. I mean, this is not pretty at all. Pretty. You can design into new technology, new architecture, zero trust, and very high quality technology that isn't guard the perimeter. It is guard everything all the time. Yeah. You can't do that in a legacy piece of technology. Your total cost of ownership goes down. Most banks don't know what it costs them to make a single payment. They don't know. They can't work it out. Don't know. Too hard. You do know if you take the previous diagram of all the spaghetti stuff and you replace it with a box, I'm going to charge an amount per transaction, and it's just that, and you know exactly what it is. Yeah. And when something new and shiny comes along, I'm going to build it and I'm going to apply it to all my customers on a platform. Yeah. But we built it in a Coolio way. So for one customer, it's compelling. We built it on one platform, and that means that all our customers connect to the same thing, which means we're kind of getting a bit warmed up with what can you do with loads of tier one banks connected to the same piece of technology. What else could we do? First thing we can do is every time we make a change, it's shared for all our customers. They all get it. There's no versioning rubbish. There's none of that stuff. It's just there for them to use. So we're mutualizing that cost and sharing it across our customer base. They and we know it will be ready for the industry, because if we're not ready for the industry, all our customers will go dark. That's bad, right? So we will be ready on time, every time. Some of our banks are waking up to the fact that they might be able to use our platform to send messages to each other. That would be pretty cool. We can do that. It's not our problem, but they need to work out what they want to use it for. Maybe they want to share some extra information to kill fraud that they can't currently get to each other. If you try and take all those bits of spaghetti and work out how one bank sends their spaghetti output to some other bank's spaghetti output, it's really hard, right? So they might want to use us for that. All our data for all our transactions is exactly the same for every payment type for every customer, and it's in one place. We think we might be able to do some interesting stuff with that. Most notably, we're going to shoot at the bad guys and try and kill the fraud. Yeah? And we've had the opportunity to invest in resilience in a way that no tier one bank can afford to do. Mostly because we spent all of Ben's money. Thanks, Ben. Wisely spent all of Ben's money. So here's an example. So a payment scheme in a country says, I'm going to do an upgrade. Did it in Europe. We did it for 10 customers, arrived bang on the date, as it should have done, 5 man-years worth of effort. For us, one bank, 200 man-years, 6 months late. Yes! I've got a fan of one. It's good. I feel like I should have like those DVDs and a little thing at the end. It's all good. Right, okay. We can spot on our platform at north of 90% fraudulent transactions between two parties on our platform. North of 90%. So we would think it'd be quite a good idea if they asked us to turn it on, right? This is over and above what the banks already think they're catching. Going to talk about resilience. We built this shiny thing. So back to Ben's point about IP. If you're going to do it, like, just go all in, right? So we went all in. So we run actively across 3 public clouds in real time all the time. So what that means is that when a tier 1 bank hits us with a transaction and says, make it so, if we were to lose all of AWS in 3 availability zones completely at the moment they gave us the transaction, the same transaction would complete in real time out the back end of GCP, and their customer would not know. And the other way around, and on the way in, and into Azure. Nobody has deployed technology like this in banky land. No bank can build this. 2 different tier 1 bank CTOs told me it was impossible. It's now in production, running about 20% of the UK. But it's hard. So our engineers are a bit world-class, super geeky, sit in their basements, completely remote, built ticketing services, built airline booking systems, built streaming services, built search engines. Geeks. Brilliant. But I guess the other thing that's very interesting for us is, I guess we think about innovation in a way where you don't change it all in one go. So one of the ways we think about this is the continuous change in the way we talk to our customers. So some of our biggest customers are also investors. So we have financial investors, we have strategic investors. They sit on an advisory board for us. They help us navigate where do we go next, where should we invest, where are our big problems, all that good shiny stuff. And I guess we really start to think about prioritizing not just technical excellence, but also commercial value. Where are we today? We are contracted for 50% of all the payments in the UK, and we're just putting it on. We're 8 years old. It's not bad. We'll take it. 350 people, so it's not super heavy, but it is infrastructure, and it does take quite a long time, and banks don't buy nice. So we work really hard at working with big, complicated banks to not upset them when we show them this picture and say, would you like a slightly different shaped picture? Yeah. We do this completely remote. So our 350 people, we have one office with 25 desks in it that some people turn up to very occasionally. The entire organisation, built remote, runs remote, has always been remote, nothing to do with COVID. 33, I think it's now 35 customers, and we're running at about, by the time we get to March, we will be running at about 5 billion transactions a year run rate, which is about 1.2, 1.3 trillion pounds every year. That's the exit run rate. I think it will take us about 12 to 18 months to double that to 10 billion, give or take. These are our customers. Pretty cool. You can read all of those. I guess what's really interesting for us is same code base, same API, same platform, works for PayPal, works for Square, works for Stripe, works for Klarna, works for JP Morgan, works for Lloyds, works for Nationwide, works for Goldman Sachs, works for Santander. Same. And so whilst it does take us quite a long time to persuade a really big ugly bank to give us their business, what's really good about it is that not only are those key bank customers interested in this, Visa and MasterCard are also customers of ours and investors in our business, because they also know that the world of account to account and card will converge over time, and technology assets that are working like this give the world the best opportunity to think about some really cool user cases. Yeah. That, I think, I don't know if that was it. Oh yeah, investors, people who give us money. Sorry, Ben. Last slide. Should have started here. Play to your audience. These are the people who've given us money to have a go. Our expectation is most of the big customers that use us in really big domestic home markets for all of their customers will probably end up also being strategic investors. And this is a well-trodden path for payment infrastructure. It's how it's how the original card scheme started. Visa particularly. It's how Vocalink started as a business, if you guys are familiar with them. This is a well-trodden consortium-driven business. We're not a consortium-driven business, we're a commercial business, but that helps us to navigate some of the challenges in the market for regulation and use of tech. This is what we do. Is that all right? Benza.
I just find it curious that Visa and MasterCard has invested in your business, because they, as we all know, take a hefty margin between client and vendor.
Yep.
And experience taught me that the margin on these things is very low. How do you think your clients will deal with significantly low margins?
So the entire account-to-account market works on per click, not ad valorem fees. So the card infrastructure is percentage of value. The entire account-to-account landscape is per unit fee. The reason Visa and MasterCard are interested in this is because they also need to plug into these same sets of systems. And they're also trying to work out how they can talk to their bank customers about doing things that aren't just card. So they are trying to build sort of networks of networks. And we become a technology partner for that. So our customers are, from our perspective, really, MasterCard and Visa are a customer just like a JP Morgan or a Lloyds would be a customer. And all of our investors are all minority shareholders. It's really important for us, because if we become the dev shop of a bank, game over, because we will just start building back to this legacy platform view of build it special because I'm special as an individual bank, and they clearly are special as a customer, but the solve for this market is do it once and distribute to many in a consistent way. So we've never had any pushback from existing customers or future customers about Visa and MasterCard being part of that journey.
You must hear many stories like this where you think, my goodness, I just want to invest. How deep a dive do you need to do to really understand if it's going to pay off 3 times or 10 times? And how successful have you been in not investing in the ones where you got nothing back?
It's a good question.
Thank you. I'm here all week.
You get very excited about the tech. It's true. So the technology is often exciting, and quite often you can see the market opportunity. It makes a lot of sense. Timing of your investment is the key, because timing kills most deals. So if you get into, let's say you get into an interesting company in the early 2000s, a lot of what we're investing in now were ideas that existed then, but the infrastructure wasn't available to make them come to the fruition. Whereas now you can go to the same ideas and they make a lot of sense because you've got the compute power that can sit behind them. What is still true though, so if I think about quantum computing as another example, that we have a software company that sits across quantum hardware. So we're thinking about this, the same technology stack that existed previously, but it's underpinned by quantum. You're then saying, well, okay, this is an interesting theme and it's an interesting market, and clearly value will be created. How do we as a house want to play that theme? Do we go and choose the hardware player and get into the science and say these guys know better than this one? That doesn't tend to play out very well. So what we've done is to say, well, there's a software layer that supports all of that hardware. And so really we're thinking about playing the infrastructure. So we're playing the thematic, but we're doing it by trying to play across that theme. And we've done similar things with blockchain security, where we went with the security layer rather than picking an underlying cryptocurrency winner. And we say, okay, actually we have a company in France called Ledger, which creates the wallets that give you the security around that infrastructure. That's the way we try and play those thematics. So your point about timing is really valid. You can get super excited when there's plenty of investments that we've made where you get the timing wrong because the market changes, regulation changes, the incumbent players adapt to what's happening. And so only really 30-40% of the time are we getting it right and getting the outsized returns. And that's why venture is a model where you really have to manage that portfolio, and you also have to play across different vintages. Thank you.
I would, not because he's just stood here, I would add, we thought really hard about where to take money from, because money is money. And actually what we need is people who are understanding the nature of the industry and the fight we're trying to pick, and who will sit on a board and help us to do that. And you find out really quite fast whether somebody's got a checkbook or expertise, particularly in the VC community. There are lots of people with checkbooks. The expertise varies quite a lot in different sectors based on the themes they're trying to pick. Yeah, and so this was a good match of hypothesis and thesis from Molten and where we wanted to take our business. Other organizations, very, very tiring and labor intensive to try and educate on a whole market and why you're trying to do the things you're trying to do. And that just doesn't really add any value. And so we've always tried to think about that sort of capital structure from the value of expertise for us.
Is this technology that you're using completely different to blockchain?
Yes. 100%. So the blockchain is not capable of dealing with the speed or the volume of that real-time account-to-account landscape, and it's too expensive to run for that. So this is a all-current tool running public cloud applied to this very specific kind of problem in banking where they're just using much older original versions of mainframe technology and software written in languages that people can't even write anymore. So it's blockchain. There's no reason why our platform couldn't start to think about connecting to blockchain, but our business model is all about scale, and there just isn't enough of it in blockchain.
And your biggest strategy, Ben, is that rather different?
Well, we will look across the portfolio at different stages of maturity of those companies, but the majority of what we realise will be M&A. So it'll be sales into large corporates. So the scenario that Mike outlined there, where people want to buy in the technology. We are also happy for an IPO process if that's the route that the company wants to go down and it creates the best value. Ultimately, we will look at both paths at the stage that it's right for the business. So we're agnostic in terms of what's right for the company, but it's actually a preferred route for us generally as a generality across the portfolio to have M&A, because we'll get our cash out earlier. We won't have the vagaries of the public market. We won't have a lockup. So that tends to be that we prefer to do that.
So, Mike, are you going to be another brilliant UK tech startup that ends up in the hands of the Americans? That's where they've all gone.
Don't know. Don't know. Don't know. I think it will depend a little bit for us on how successful we are in the US from a product profile and a customer perspective. So, we're super successful in the UK. We've got quite a lot going on in Europe. We've just started in the US. I think the answer to that will be how rapidly can we grow in the US and how relevant do we become in that market? And then I think that would be not an unreasonable outcome. I don't think we would push to the US just because that was a financial decision. I think that would not help our tier one client franchise. Every month we hit delete on the platform and we wipe it out and we rebuild it whilst it's running, and we do it every month. And so the ability for us to keep going regardless of what is happening to us is extremely high. Banks can't quite unpick themselves like that, so they will try to achieve no interruption, but sometimes it's just technically not possible to achieve non-interruption because of the technology they're coming from. The new stuff they put in that wires into us and plumbs into us wouldn't have that as an issue.
Hi there. Are you original founder, and how many other founders are there?
I am. Okay. Sorry, the question was, am I a
original founder
Yes.
of the company, and how many other founders are there?
Yes, we three. Yes, CTO still in post, and exec chair.
Still friends?
So far, yes. It's going okay. We've not had a reason to fall out. Yeah, it's hard. I mean, it's doing it. I mean, you do have to be slightly mad, and it's really hard. I don't know if. I mean, I know I'm preaching the converted. What the reason? One of the problems you don't want to lie awake at night worrying about is access to funding on real world problems you really want to go for, right? But I don't know if anybody's seen that thing that went round on LinkedIn, which is, the guy running on a treadmill while somebody's pouring Lego onto the treadmill. I don't know if you guys saw this. Starting a company shooting at these types of customers with this type of technology in this type of market is like trying to dodge all the landmines whilst they're moving, whilst you're running, right? It's really quite hard. And I think we've met a lot of investors and current investors where I think they recognise that some really strong groups of founders have a much higher probability of success because it's that hard, yeah. And so being able to work through problems and approach it from a different perspective is really I think is really important. Yeah.
I think where you as a group were also differentiated is that you had experience working in your customer base.
Yeah.
In the big banks, you knew their problems, you knew how they would go about solving them, so you could see the solution. But that also doesn't necessarily mean that the journey's any easier, because you still got to get funding. You're still taking risks on how they're going to behave, how regulation is going to change and behave. So I think, the plaudits for the people that take the risk and the entrepreneurs. Even when they're not successful, they're still creating jobs, they're still creating innovation, productivity. It's massive.
Yes, sorry, last question. Are you also responsible for the cybersecurity?
Am I responsible for these?
Cybersecurity.
I have a chief information security officer and a team of about 50 people whose job it is to protect the platform that we run. Yes, absolutely. Yeah. It's you don't want to talk to him at a dinner party. The world is really quite scary. The world is really quite scary. But I think, again, if you go back to what is the technology solve, I can't emphasize enough the difference between the old world of technology and cloud native as a technology. Like, I can't emphasize this enough. It's completely different. So, security is a really good example. So, banks used to have vaults, like doors, and then they started building some technology, and so they did the same thing, right? They built perimeters around it, like you would build a vault or like you would guard the doors on a branch. Why wouldn't you? And actually, for legacy tech, that's okay, right? Problem with that is, if you get in, the bad guy walks out with all the money, and it's really hard to stop it because you've protected the perimeter, but your ability to protect all of those interfaces and internal activities is really difficult. What is really interesting about a cloud-native microservices architecture is we have something like 400 different services running across these public clouds, and they each operate on the principle that the thing that's trying to talk to them is a crook. So every single message that runs between these different services doing different things is all encrypted and believes it's trying to get hacked. And so if somebody gets into one of those boxes, it doesn't mean anything. We don't even know the address of our data centers. Like, we don't know where they are. Like, we couldn't break in even if we wanted to. In fact, I think today the UK government has just designated key data centers as critical national infrastructure for this reason, right? Like, they don't exist. So I think one of the things you can do today that you couldn't do before is design in whole new levels and whole new types of security that it's very, very hard to retrofit onto old technology. Which is why these guys, I think we're 15, 18 tier one banks every year, they just come and beat the shit out of us every year, right? And they have hundreds of security people to make sure that the way we do things is actually better than the way that they would be able to do things in-house. But it is an existential risk to the operation of economies. Yeah. Not us specifically, but just this is a problem. Yeah.